you're seeing this in the headlines, and I want to explain to you why and what's going on. So first, I'll start.
So here's really what's going on. So there's different type of rates, right? There's mortgage rates, there's the Fed funds rate, there's the discount rate, there's the prime rate. Um, what you're seeing is a lot of issues in the 10-year. The 10-year is going up because of we have a bunch of treasuries are about to mature, and if we want to, sell the new round of treasuries, we're going to have to increase the coupon on them, right? Which is the interest rate that we pay. So those are going up. Those are directly tied into mortgage rates, which means, if you're in the market of buying a house, it's just going to get worse, right? And then there's the discount rate, which is set by the Fed. That continues to decrease. However, there's a lot of talk about inflation these days and how it's getting worse instead of better. So that's why the market is scared. That's why you've seen some volatility. That and the new president coming in.
Start with this. Interest rates on government debt is so important because it causes a chain reaction. So basically, if interest rates on government debt goes up, what's going to happen? Interest rates on mortgages, on auto loans, student loan debt, credit card debt, business loans, those interest rates will go up too. If interest rates on government debt go down, then naturally those interest rates will go down as well. Okay, but today we're just going to focus on the stock market. Okay, so let's just start with this. And I'm going to give you an oversimplified example just to make the point crystal clear. So let's just say that interest rates on government debt is 0%. So in other words, if you buy a treasury bond, a government treasury bond, they're going to pay you 0% interest. In that case, it's going to be the same thing with the banks. The banks will be offering you a 0% interest rate on your savings accounts or a CD. Okay. So all right. So I want you to think about that.
If you were to get a 10-year bond and it was 0, then mortgage rates would be close to that too, right?
As an investor, if government bonds are offering 0% and the banks are offering you 0%, then the stock market becomes much more attractive to you. Because do you want to buy government bonds that will pay you 0%, or do you want to leave your money in the bank and they're going to pay you no interest? No, of course not.
And that was the debate. That's been the debate on CNBC for the last couple of days, because the 10-year keeps on going up, and they're talking about yields. What's going to yield you the most, right? Is the S&P going to yield you more, or are bonds going to yield you more, right? So just like a couple of basis points, and yes, they're going to continue to go up, the bonds, but a couple of basis points in the bond market is not why we're seeing the stock market volatility right now.
Right? So you would be more inclined to invest your money into the stock market and try to make more than 0%. So that makes sense, right? So naturally, lower interest rates are good for the stock market. All right, now let's look at the flip side. So let's just say, and we're going to use an exaggerated example again. So let's just say that we're in a very high interest rate environment. Treasury bonds are offering you 20%. Banks, we're talking about savings accounts and CDs, they're offering you a 20% interest rate. So in that situation, as an investor, just think about it. Why would you risk money or more money in the stock market when you could put money in a CD? You could earn 20% risk-free. So in a higher interest rate environment, you'd be more inclined to dial back your money in the stock market, or just basically not even invest in the stock market if interest rates are very high. So higher interest rates are bad for the stock markets. So basically the key takeaway is that there's a competition for your money. The stock market, the bond market, cash instruments, they're competing for your money. And you're going to be most motivated to invest your money where they're paying you the best. So if interest rates on government debt,
sometimes, right? If you are, let's say, retired and you're in the fixed income market, you're just going to try to look for the best rate, right? Or if you're filthy, stinking rich, usually those people try to protect their assets. They'll get something which is tax-free, like a in-state municipal or a U.S. territory municipal bond.
Is higher, that's not good for the stock market. But that's besides the other points. As I said, it's a chain reaction. This is just one point. Of course, higher interest rates affects the economy, it affects corporate profits, and those things, with many other things, affects the stock markets. Now, the 10-year Treasury is the most important government debt for you and me.
This thing keeps on going
most
up.
Interest rates are
and it's going to keep on
correlated to
going
this
up.
one, such as mortgage interest rates. That's just one example. So if this goes up, mortgage interest rates go up. If this goes down, mortgage rates go down.
Hit 10,
So this
10
chart
basis points
is since
that
2020,
chart
and as you can see, we're near an
gone up.
8-month high. So if you look over the past 12 months, it's really shot back up there. Now, a good question is, okay, so the 10-year yield is around 4.
And if you look back at that chart, you can actually see the mortgage rates. They will mirror that chart perfectly, right? And that's the 10-year.
4.7%. But, what does that mean? Is that good or is that bad? So let me answer with just jumping right into this question. So the question is, at what interest rate does this become a big problem for the stock market? And according to Goldman Sachs, the answer is 5%. So according to their new 19-page report, which is based off of historic data, they said that historically, bond yields at around 5% is when higher yields become a clear problem for equities. So this was from Goldman's, their team, led by Peter Oppenheimer, their chief global equity strategist. Okay, so another good question is, what is keeping interest rates on US Treasuries so high? There are a variety of reasons, but I'm going to give you 3 of them. So the first one is higher inflation expectations. So investors want to be compensated more with higher interest rates for higher inflation risk. So I want to give you a real life example. So me personally, this is how I see it. If the banks are offering to pay me 3% to lock up my money in a CD for years, I'm going to say, no way, I'm not going to risk that, because if inflation comes back at 5%, 6%, 7%, then I'm not going to have my money locked up and earn a lousy 3% and lose to inflation. No thanks. So the second reason is a more resilient economy. So listen, the economy is not booming right now. However, the economy is not cratering yet. So this reduces the Federal Reserve's urgency to cut interest rates aggressively, which leads to higher interest rates.
And there's 2 disconnects within talking points. So if you go to the CME, right, it says there's going to be a rate cut by 25 basis points next meeting, right? And it says 97%. And it's very hard for me to say that's not going to happen when you see a number like 97%, right? But there's a lot of talk about how that's a bad idea. So we'll just have to see. But there's getting to be a lot of uncertainty in the market, which of course increases volatility as well. And that's part of the part of the reason why you're seeing options contracts sell for so much right now.
And another reason is foreign demand for treasuries has been stalling. So as I showed you in my last video, China is done lending money to the US. Japan has been decreasing their treasury holdings. And of course...
And that's another thing. If you're a Chinese financial institution, you're not even allowed to buy US treasuries anymore, right? So that 10-year is going to go up. So 2 things can happen, right? Either the rates go up in the 10-year, which makes it extremely hard for you to get a mortgage, or the Fed buys the treasuries, in which inflation is going to increase. It's going to skyrocket. So, if you have, you need to stay in assets right now, and it's a little crazy.
We have trillions more of supply that's going to hit the markets this year. So listen, if you want clues as to what's going to happen to the stock market, just look at the bond market. Track interest rates on government debt. If interest rates on government debt goes up, that's bad for stocks. If it goes down, that's good for stocks. And my advice is to look at the 10-year yield. That's going to be the most important one. But of course, it's not just interest rates on government debt that affects the stock market. There's plenty of other things, but this is a big influence on the stock markets. In terms of the Federal Reserve, they've been cutting rates, but now they want to pause the rate cuts. So here are the odds for their next meeting on January 29th.
And that's gone up to 97?
There is a 95.2% chance that they do not cut rates at their meeting in January. And I want to tell you these three important things about the Federal Reserve that are relevant to this conversation. So the first thing is that the Federal Reserve has more influence on short-term treasury rates, especially the ones with 1 year or shorter maturities. So longer-term rates, they're more influenced by inflation expectations, economic growth projections, and global market conditions. But the reality of the situation, this is just talking practically, is that if interest rates got too high, the Federal Reserve could always print trillions of dollars and buy up treasuries to lower rates, which of course they don't want to do right now because they haven't beaten inflation. Now, a very good question is, could higher interest rates cause a pullback in the stock markets? And the answer is absolutely. Of course it could.
And again, that argument is because the bonds and other treasuries are going to yield more, especially at a risk-free rate, than the stock market, right? But if he says that, as he says, there's going to be inflationary pressures, equities like stocks are a great inflationary hedge, right? So you got to compute all of that.
But I'll tell you this. If the stock market goes down 5%, if it goes down 8%, the Federal Reserve, they're not going to do anything. But if the market goes down a bigger amount, let's just say 20%, you know that they're going to get involved. I mean, they're going to come running to the rescue. They're going to do lower, emergency rate cuts. They're going to do QE, and it's going to be a V-shaped recovery. You have to remember, in the long run.
And that's really, look, that would get the entire business cycle going again, right? It would help housing. It would help everything start going again. But, people don't want to do that because they're going to freak out, right? But if you have some money on the sidelines right now, that's what you're waiting for.
Stocks just go up.
But I doubt that's going to happen.
So I'll tell you this. If the stock market goes down, do not panic sell. Honestly, the best thing to do would probably be to cost average in, just keep on adding. Stay
dollar
calm,
cost averaging.
Stay cool. Don't do anything crazy. Don't go all in, and don't leverage. Don't borrow money to buy more stocks. But
definitely don't buy anything on margin.
Stay calm and cool with a long-term mindset. And I do want to say this. So I understand. I'm fully aware that a lot of people actually want this to happen because they see this as, if this were to happen, they would see it as a buying opportunity. And I don't blame them. Essentially, just don't panic sell. And if you can, just buy the dip. That's all for today. Please let me know what you think about the whole situation. Thank you for the support. And I wish you a very nice day.
That's Clear Value Tax. Give them a
care.
like and subscribe.